Hello and welcome from KBM, an AAT approved learning provided in the United Kingdom. This video is about remembering debit and credit items. Many of you struggle remembering debit and credit, whether sales is debit or credit, sales return, assets and liabilities. Check out this one with DEAD, dead, and CLIC, a very popular mnemonic in the United Kingdom. Dead click, you remember dead click? Debit and credit items would be very easy for you. D for DR, not the doctor, yeah. C for CR, DR debit, CR credit. Then if you follow vertically, E expenses, A assets, and D for drawings. These are your debit items. Expense, assets, and drawings are your debit items. Dead, debit. CR on the credit side, liabilities, I for income, and C for capital. Now expenses, you can have many examples: rent paid, salary paid, all the bills, telephone expense, electricity, and the list goes on. Assets are short-term, long-term, current and non-current, like land and building, motor vehicle, cash, bank, trade receivables, right? Closing inventory. Drawings, items withdrawn by the owner for his personal reasons from the business. You can put purchases into the expenses, like goods bought for resale purposes, purchases. On the credit side, liabilities, again, like assets, you have short-term and long-term liabilities, current and non-current, like loan, mortgages, and trade payables, short-term liability, yeah. Bank overdraft, OD, bank OD. Income, think about sales, rent received, commission received, discount received. These are your income items. Capital, money introduced by the owner into the business. Now usually asset, expense, and drawings are debit, liability, income, and capital or credit. You remember the dead click, life would be easy. So changing the color of the pen and highlighting for you, like this is your dead and this is your click. Is it always like this? No, little extra mile. If your debit items goes up, it is debit. If it goes down in the account, it becomes credit. How? I will show you in a minute. If the credit items in the account, it goes up, generally these are credit. If it goes up, it is credit. If this goes down, minus, it is debit, the opposite. For example, let's start with the T account, and in this video I'll show you the T accounts as well. One question: what goods of £200 paying by check? Now, what goods is basically purchase, no? Purchase account is what? Purchase is your expense. Expenses are debit. Right. Paying by check. Check is a bank item. Your bank going down. Bank is an asset. Assets are usually debit, but what if it goes down? This time your bank is going down, isn't it? So cash or bank going down, that becomes credit, yeah? How do you do in a T account? You open two T accounts. One is purchase, one is for bank. Purchase, left hand side is debit, you already know it. Right hand side is credit. Left hand side debit, right hand side credit. Two T accounts, one debit, purchase debit, and bank credit. How do you show it? At first you write on the debit side money. This is money column 200, purchase debit, and this money column bank credit. The other two items are basically for date. Let's assume this is the first of any date, May 25, and this is also the same date, 25, 1st of May. In the detail, you write opposite account's name. Yeah. So in this particular 5 minutes video, you're learning how to remember debit, credit, also how to do T accounts. So in purchase account, we write bank. In the bank, you write purchases. You remember debit, credit, so dead click is very helpful. Also watch the video on PEA RLS pearls, like PEA, purchase expense assets, are your debit. RLS, revenue, liability and sales, are your credit. Hope it helps, and see you in other videos.